Good morning. Happy Friday, everybody. Welcome into this week's long-form episode here on Mining Stock Daily. Trevor Hall has returned from my time up in Vancouver. Really appreciate getting to see as many people as we could. Special thank you to Jay Martin, the VRIC team, and also the entire AME Roundup team for allowing me to come in. We did a couple of interviews, as you may have seen. Always go back and listen to those if you had missed it, but great way to kick off New Year when you get to spend a few days up in the wonderful city of Vancouver. So we're going to go back and talk kind of big picture macro here in the United States, just a few days after the inauguration of President Trump's second term. Happy to welcome in Barry Knapp from Ironsides Macro. There's a lot to cover here, including how the incoming Treasury Secretary will have to deal with the long end of the yield curve and also battle inflation expectations, not only economic expectations with his boss, Donald Trump, as well. So great conversation with Barry, about 45 minutes of give or take in its entirety, and we cover a lot of ground. Special thank you to Vizsla Silver, Arizona Sonora and Copper, and Caliber Mining for their continued support of Mining Stock Daily. And that's it. We'll get into this conversation with Barry, and then we'll be back next week with regular scheduled program. All right, everybody, enjoy and be well. All right, everybody, welcome back into Mining Stock Daily, and we're going to get some long-form market updates here. Happy to welcome in our friend Barry Knapp, one of Colorado's favorites, although, like me, he escaped the polar vortex of Colorado and those frigid temperatures. He did something smart. He went down to where it was actually a little bit warm down in Arizona. I went up to Vancouver. Barry, I'll be honest with you, it was night and day difference. Even in Vancouver, it was warmer than it was in most of the United States over the last 4 days. So I think you and I both lucked out.
Well, everyone I've been talking to in New York is really complaining. And when it's zero in New York, right, it's, may as well be minus 25 in Vail, So.
That's right. So my kids had to do ski training this week, and through those temperatures, and I called them Sunday, and I was like, does everybody have all their fingers and toes? They're like, yeah, Dad. I was like, okay, I'll take it. Yeah. Okay, so the last time you and I chatted, Barry, was immediately after the U.S. presidential elections. And so obviously we don't need to hash out a lot of that stuff, but we're chatting immediately after post-inauguration. And there's been a number of executive orders come down the pipeline, not necessarily, a lot of it maybe not applicable to the conversation you and I are going to have today, Barry, but some of it is, because it has to do, some of those executive orders have to do with inflation and being representative of cost cutting for consumer goods. And obviously tariffs are always on the table here. But now that we're, 3-4 days into President Trump's second term, how are you kind of watching things, or what are some of the things that are really on top of your mind that people should be paying attention to?
I had a monthly catch up with a macro hedge fund yesterday, and the first 30 minutes of the discussion were all about the sequencing of policy, tariff or trade policy versus tax policy. And, I started to write my note for this week, and I said the fog is beginning to lift, right? Because we're starting to get a clearer picture of how things are going to unfold. The first thing I would say on trade policy, there's some optimism that trade policy, certainly in the case of Canada and Mexico, is part of the deal with goals other than necessarily shrinking the trade deficit, although that's not inconsequential, but, is really about other things like sealing the border, so on and so forth. There's, a whole school of thought that tariff revenue is going to be used to offset CBO scoring of tax policy lost revenue. I think the way to think about trade policy in aggregate is, I'm trying to recreate it myself, but I saw the reciprocity line on Twitter in a couple of occasions. And in essence, it's on the vertical axis is what we charge imports from our imports from our major trading partners. And on the horizontal axis is what we get charged to export to our various trading partners. And virtually every country in the world is below the reciprocity line. So in a lot of ways, that reminds me of the whole tax policy discussion in 2017, where we had the second highest effective and statutory corporate tax rate in OECD, and it was obvious that it needed to come down. So this is similar in as much as it's obvious that there needs to be some level of reciprocity. Now, thinking that our major trading partners are going to suddenly just acquiesce and reduce their tariffs and non-tariff barriers to entry, I think is a little bit naive. So within that context, tariffs are going up, is my conclusion. Whether they'll be able or eligible to be counted as a significant portion of revenues to offset tax cuts, to me is important, and I actually hope that they're not. And the reason I hope that they're not is because when I think about the treasury market, which was perhaps when we spoke, I said this, I've certainly said it in my writings and I've said it on television, until and unless we meaning Congress, gets spending on a path to return to 20%, slightly more than 20% actually, of GDP, we cannot stabilize the treasury market. That term premium will continue to rise. 5% seems, a retest of 5% on 10s seems inevitable. We have some really intractable problems, that $2 trillion deficits at 7% of GDP. We're just creating more supply. It's the opposite of the equity market where supply is shrinking. In this case, supply keeps going up. So until we get it's either the first or second arrow of incoming Treasury Secretary Besant's, three arrows getting the deficit down to 3% of GDP. Until and unless we do that, we really can't stabilize the back end of the bond market. We have a Yellen Treasury that was financing it with over 30% of bills. That needs to be corrected. It's inherently unstable. The Fed still owns $6.5 trillion of treasuries and mortgage-backed securities. It looks like QT, based on the trajectory of reserves, is likely to continue until September now, whereas estimates at not this FOMC meeting, but back in September from the street was QT was going to end in March. Now it looks like it's going to continue. And then we still have the question of, should they be reinvesting in longer-term securities or returning to a bills-only policy and reducing their exposure or their influence on the back end of the bond market? That's an open issue. Both of those things are going to push rates higher, term premium higher. And the only way for me to stabilize that is to get spending cut. So I'm actually optimistic about spending, but we won't know anything about that till April at the earliest. They are going to settle for one reconciliation bill, which is crucial. The Thune idea where they do energy, immigration and defense, get an early win and then move on to tax policy, to me was going to be a disastrous outcome for markets because it would create massive uncertainty and put the stick of trade policy ahead of the carrot of tax policy. So we really do need that to happen together. But in the meantime, that the Trump economic team of Bassett, Hassett, and Moran, which I think is a really good, adept team, a much safer set of hands than Biden had us in, has these formidable challenges. And they're really waiting for Congress to actually be able to cut spending. I think it's possible. I don't agree with the arguments that we can't do it because discretionary has become too small a part of the budget and there's nothing you can do on entitlements. Sure, they're not going to change eligibility, but listen, spending was 20% of GDP before the pandemic. Biden put it on a trajectory to stay at 24 to 25% for the next 10 years. We can get it back there. But, we won't have any visibility into that for at least 3 months. And as we know, a lot can happen in the markets in 3 months. And so I just see the Treasury market as being a real source of risk for the next couple of months, unless somehow magically the BLS fixes all their seasonal adjustment factors and we get really benign CPI and employment reports, unlike the last couple of Januaries where we've had disastrous inflation and employment reports. So anyway, that was a lot, but that's the net message is the treasury market is still the major source of risk to equity investors, commodity investors, currency, exchange rates, and is the clear and present danger, so to speak.
Barry, every time you and I talk, I take something else away. So I guess you're a great teacher. A great teacher always allows students to follow up with more questions, and I think I've got a lot more questions now than I did when we first entered this conversation. And I want to go back to this kind of extension of Fed quantitative tightening through what you would say most likely into the fall of this year. Just in my car, I was listening to President Trump speaking at the Davos Economic Forum, and he mentioned wanting to decrease interest rates, and not only just for the U.S., but having ramifications and implications for the rest of major global markets and their bond markets. But it almost seems like there's, on one end, you have the correct policy of what needs to happen with quantitative tightening due to the extent of what's on the Federal Reserve's books on the long end of the curve. But then you have a president coming in here who we all know kind of his demeanor, but he's going to want something quick. So how does that balance out as far as, the Treasury market, what needs to be done with a president who's coming with an economic drive to lower those interest rates, deregulate, and really expand corporate America?
So this is a really point of differentiation, in my view, on monetary policy relative to virtually every talking head that goes on television and the Federal Reserve themselves. And that point of differentiation was they mostly eased through their balance sheet. If you use models of, large-scale asset purchases, QE, impact on the economy relative to rate cuts or hikes, they effectively cut rates by 150 basis points during the pandemic and did the equivalent of 250 basis points of rate cuts in terms of the amount of securities that they bought. So what they did was had an outsized impact on the long end of the curve, which directly led to a 46% increase in the Case-Shiller home price index, right? Created this massive malinvestment in crypto schemes and meme stocks and everything else, right? So they eased conditions for investors, which most of assets are discounted based upon longer-term rates, and didn't provide as much relief for short-term borrowers, for example. So when they started tightening, I was absolutely insistent that they needed at least symmetrical policy, meaning they needed as aggressive a balance sheet unwind as rate hikes, but they did the opposite, right? They raised rates 5.25% and only passively unwound their balance sheet. So that created a 25-month disinversion of the 3-month 10-year Treasury curve, the rough proxy for what a small bank's profits look like, right? Taking in deposits and lending the money. And it crushed the small banking sector, where return on equity is down to 5%, which cut off the supply of credit to real estate developers and essentially put all of the burden of policy tightening onto small banks rather than large banks who held all the cash and benefited from the rate hikes. It had bond portfolios that looked like the Fed's and hurt small businesses while not really shifting that burden onto long businesses that could borrow in the credit markets at longer-term rates, right? So it was a very disproportionate and clumsy policy tightening process. So here we are today, and there is a way to really start to equalize this. So I have a forecast this year that we get 100 basis points of rate cuts, right? I had a meeting with former colleagues earlier this week, and one said there's no more rate cuts coming, and another said that there's one more rate cut coming, and everybody's sort of dunking on my forecast and saying, well, economic conditions, inflation, and employment will never justify your forecast. my forecast from a pure Fed mandate inflation and employment outlook is 50 basis points of rate cuts. The other 50 basis point comes from Bessent extending the maturity of their issuance, which will drain less liquidity out of the system because there's less T-bill issuance. That allows QT to perhaps even extend through the entirety of the year. It's my former colleague, Joe Avante at Barclays, who's changed his forecast to September based upon the level of bank reserves in the system, which really haven't come down. If Bessent increases the duration of issuance and starts issuing more notes and bonds rather than bills, then QT could run through the whole of the year. So that actually means longer-term rates go up a bit, all things equal, but that would allow the Fed to cut the policy rate by another 50 basis points, let's say. It's a forecasts are difficult, especially when they're about the future, right? Yogi Berra's statement. But the point being is that would equalize the tightening process across owners of assets like households that own stock portfolios, own homes, and longer-term investment-grade credit borrowers and small businesses, real estate developers and the like. And so you could have Trump's, cutting rates at the same time that now you stabilize the back end. And as I said earlier, the real key to stabilizing the back end from a longer-term perspective is getting spending on a trajectory back to 20% of GDP. So you could wind up with, in aggregate conditions, much easier, much more stable. And so Trump can get what he wants. It probably means we have to go to 5% first to force Congress to cut spending, right? And scare them a little bit. Market forcing mechanism, if you will. But I think all this could happen, but it does, again, back to my point I've now made 3 times, which is the most difficult thing for Congress to do is take something away. It's easy to give somebody something, cut taxes or increase spending. Hard to take things away, which means cutting spending, but it's absolutely crucial that we do that. And if that happens, that allows short rates to come down, longer term, issuance, the Fed to shrink their balance sheet, and it all to come off without any serious disruption and allow what's been the biggest real macroeconomic impact of the Trump election, which is an absolute surge in business confidence at the small business level and through all the various Fed regional manufacturing and non-manufacturing surveys where you see orders just future expected orders exploding, expected CapEx plans exploding. So you can get all that, you can realize all that CapEx and realize CapEx has been falling for 3 years under Biden. You can get that to change, which increases the outlook for productivity, makes a much better mix of growth, and improves corporate profitability for more than just, Gen AI related stuff. I mean, it's not lost on me that materials and energy sectors were up 0 last year. The guys that are going to build the infrastructure for the AI data centers, when the AI stocks themselves went up 40%, right? That doesn't make all that much sense, right? So we can get to that second, broadening out, but all these things need to happen. And like I said, the absolutely necessary condition or sufficient condition, I suppose, is that government spending gets cut to 20% of GDP, and that stabilizes the bond market and makes all this possible.
Oh, and there's only so much the Department of Government Efficiency can do to get some of those cuts happen. It is going to take a majority of the most meaningful cuts is going to take an act of Congress.
100%.
And I'm actually a little bit optimistic with you, Barry. I do think there are a few individuals in Congress on the other side of the aisle, on the Democratic side, that kind of understand that they need to start working with, because there's almost kind of you got to think long term to save the party, quote unquote, because you have to kind of find a way to come to the middle. That's a whole nother conversation. But I do want to come back to this CapEx that you just mentioned, and I think it's important to really be clear when you say CapEx lowering under the last 3 years of Biden, it seems like CapEx sentiment and willingness to take on projects has been lowering because of higher regulations, unfavorable business environment, and inflation, just cost overruns. Is that safe to say?
If you look through the GDP accounts, the national accounts data, right? So they break CapEx into structures, investment, physical plant and equipment, intellectual property products, which is software, R&D, and equipment investment. All three of those lines have just come down steadily over the last 3 years. We had a little blip up in the third quarter in equipment investment because we had some clearing of a Boeing backlog, so that kind of boosted, aircraft equipment. But equipment investment through the durables account, the core capital goods ex aircraft, are running at 1% annualized, right? Software investment, which has just been straight up from lower left to upper right since, I don't know, 30, 40 years, that flattened out and actually came down. And structures investment, although we had this surge of technology-related equipment or plant investment going on, the semiconductor plants, Samsung and Taiwan Semi are building and Intel are building, that's all started to flatten out as well. And overall structures investment has been weak. So, when you looked at the plans, those weakened through election years, and generally CapEx runs about 5% below trend during election years related to uncertainty. It was a cool study I saw years and years ago about the sensitivity of CapEx to stock prices during election years. That falls sharply. So even if share prices are going up, companies still don't really raise CapEx in response to it. Now we've had this 6-month forward surge in capital spending plans for manufacturing and non-manufacturing companies that are available in those regional Fed surveys. Empire State, Philly Fed, Richmond, Dallas, Kansas City all do this. San Francisco has one for tech. But those need to be realized, right? And to be realized, we need to keep the confidence boom going, which, again, back to my, carrot versus stick. So, we had the Biden administration's idea for capital investment was what Chair Yellen called modern supply side economics. Most of us call that industrial policy, right? Government picking winners and losers and building renewable energy plants. Hassett, in particular, among the Trump economic team, will be the head of the Council of Economic Advisors, Kevin Hassett, that is, believes deeply in broad-based tax incentives that lets the market decide, where to invest. And President Trump mentioned that this morning in his Davos speech, how important those tax incentives are. But broad-based, right? Let the market decide what to invest in, not have the government picking winners and losers. And so that's why I say getting that stuff done in tax policy is so crucial to keep the confidence boom momentum going.
Yeah. Well, in under the last 3 years, Barry, I mean, obviously there's been a boom in data center, industrialization, manufacturing, construction, I guess.
Right.
And that's, I mean, we left 2024, we had a lot of conversations with a number of people, friends you and I both know about, is this overdone? Will these companies, these tech companies, see a real return on this investment? And even though the demand long term, it does look, continue to grow. It's going to grow. But it's just one of those things, like it's become so prominent in the last couple days under a Trump administration. I mean, just go look who was in the front row of the inauguration, the heads of the 4 biggest tech companies in the world. And so, they kind of have a seat at the table here, and that's obviously going to be priority for them. But it's still, I still haven't, I still feel uneasy about, are you going to have a meaningful return on the investment building these things, and really what it means for the functionality of the country when we're also are talking about higher energy outputs. I mean, we can talk about mining and mineral production input, something that's been totally neglected for many, many years, not just the last 4 years.
Right.
But like, is this AI build out maybe at like a moment of overconfidence? I guess is what the simple question to ask.
Well, one way to evaluate that is to look at um, valuations of the companies engaged in this, or even more broadly, look at the valuation of the cap-weighted S&P versus the capitalization of the equal-weighted S&P. The equal-weighted S&P trades 16 times forward earnings. The cap-weighted S&P trades 24 times earnings. We know why that is. It's those big hyperscalers where expectations have gotten extremely elevated, and your skepticism about them actually, achieving a return that will justify that valuation, those are warranted. As long as the investment train keeps rolling, it's hard to fight the Dan Ives point of view that the comps aren't going to get difficult. We're not going to really get into disappointment yet. That could be a 26 story, late 25, perhaps at the earliest. So it's kind of hard to fight that momentum, but I think it's a very valid point. And I hinted at that earlier when I said, the energy sector's return last year was zero. The materials return last year was zero, and they're going to build the infrastructure for all this, but not just for all this, right? I mean, if you read Chris Wright, and I listened to his congressional hearing last week, and it was phenomenal. And for those who haven't seen Chris Wright's Bettering Human Lives, 150-page glossy, going through all the uses of energy and all the broader outlook, and his general theme that we should be targeting zero energy poverty by 2050, not zero carbon emissions, right, with the idea that there's 8 billion people in the world and only 1 billion of them have access to energy the way you and I do, and the rest of the world is burning wood and dung and everything else that heat their homes and cook their food. And there's so much that needs to be built out. And if we truly want to bring more manufacturing back here and be more self-sufficient, energy runs much deeper than just building data centers, right? And so does the CapEx. And I think it's great that Trump's getting people all in on it, excited about building out these data centers and all. But we need more LNG export terminals so Europe's not dependent upon the oligarch state of Russia. And there's all sorts of reasons to really build out our infrastructure around all this. And I think that's ultimately where we're headed. But
Barry, one of the important stories that have actually, I've been out of the country for the last couple of days, but I think has been kind of shelved is that of the rebuilding of the neighborhoods in Los Angeles after the fires. And obviously I saw headlines and kind of discussions of what the state of California might have as far as regulations of how those homes will need to be rebuilt. But it was interesting just from a commodities and physical materials type of position, the markets that we follow on the mining side of things. We saw a lot of companies with the procurement trying to get as much of that material in and import it as quickly as possible before any sort of tariff kind of came into place under the Trump administration, and rightfully so. Try to get things as cheaper as you can because you don't know what's going to happen down the road. But this was all happening at the same time. Those neighborhoods in California were burning in that terrible and an incredible tragedy. But this is not going to be an easy rebuild, right? This is going to take a long time, and there's going to be a lot of materials and that's going to be needed to do such an endeavor. And on top of that, you talk about that rebuild and then not knowing kind of what those materials are going to be costing with the tariffs, or even on the physical trading markets without the tariffs. It just seems like demand is potentially could rise. And so I'm just, so there's a lot of like moving parts here, but this is one of those stories I've been trying to piecemeal in my head and see if I have a thesis. But my And I think my thesis is this thing is really set up. The physical markets are really set up to be higher in 2025 because of geopolitics, because of economic policy, but also because of surging demand in a small part of the country. And so I just want to throw that out there and see, if you have any rebuttal or, I know that that's a curveball for you, but let me know, if you have any thoughts on that.
Yeah. I had a couple of discussions about the topic. One line of questioning I received was, will it have implications for tax receipts and the deficit? Recall that in 2023, the IRS, Biden administration, allowed Californians to pay their income tax, federal income taxes late because of some floods that had taken place in California. And that actually made the deficit look smaller in 23 and bigger in 24 and kind of threw off even, the financing, how many bills needed to be sold and financing rates and all. Unless they do something on a statewide level, you wouldn't think it would have that level. This would have that level of impact on the flow of receipts into the government. But there's going to be some impact for sure. As you were talking, I was thinking about it from a perspective. We know one of the issues in this country in terms of the supply of housing is local, the local regulatory labyrinth, trying to get stuff rebuilt. And California is the worst of all. Is this the shot across the bow that forces a real change in attitude in, local regulatory requirements, environmental studies, all that stuff to be able to rebuild? Because if they continue on the path they're on, my understanding is these houses will take 7 years to build, 5 to 7 years, just because of, the way policy works. So does this shock even California into change? And if it does, if it changes in California, you'd have to believe it'll change in New York, New Jersey, right? And the rest of the country. So, that could have a profound effect on the housing market in the country from that perspective. So, listen, the other thing that occurred to me as you were talking, and I had a long conversation with a friend of mine who runs energy trading at one of the biggest banks last week. And we were talking about, this is a point he's made to me on a number of occasions, that, when you think about energy versus you think about energy equities, and certainly the same thing is true of commodity companies versus the actual commodity, energy is a spot market, right? It needs to clear. That's why we had a negative $40 price in 2020, just too much oil, and it needs to get absorbed, and there's only so much storage, right? Whereas the stocks can look forward, and, people can think about that longer term outlook. So when you look at energy today, you go, well, demand out of China is weak, demand out of Europe and Germany in particular is weak. The market's got to clear, so there's not all that much upside for the price. Saudi Arabia can try and sell more and push the price down. I don't know if it's really in their interest to do that as President Trump requested, but, they may be willing to play ball a little bit, but the market still needs to clear. But in the meantime, we have this long-term demand for energy related to data centers, nat gas in particular. What you're describing is markets getting short-term really tight because, there's no copper, right? Like, where are you going to suddenly just make the copper? It's not like the elasticity of supply is that great. Elasticity of supply in oil has gotten much greater since the shale revolution because it takes 3 weeks to drill a well as opposed to 3 years in the Gulf of Mexico kind of thing. That's not quite right, but, my sort of throwaway way of thinking about elasticity. But how are we going to get all the lumbers? You can't just send a bunch of new lumberjacks up to cut down a bunch more trees and ship them all to California. It doesn't happen that fast, right? So,
and you're looking at a 10% tariff on that if it's coming from Canada, right?
Right. Not to mention the fact that we have cold weather and that gas is going up and all this other stuff is happening. So, it's going to get tight. I do think, as much as I started out by saying I think tariffs are going up because of this reciprocity line, I also suspect that the Trump economic team is advising him. And first of all, before they initiate any firm trade policy changes, any tariff changes, he needs his team confirmed. And he put out an executive order to actually do studies on this. So the studies will supposedly go, I'm sure will go super quick. They've already done some of these studies. But they're probably advising him to try and time all this with getting serious progress made on tax policy in the House and in the Senate so that you get the carrot and the stick at the same time, right? Like you tell businesses, yeah, okay, tariffs are going up for your imports, but guess what? We're just giving you tax incentives for capital equipment investment that are being made permanent. So, if they do all that at the same time, then that helps the outlook. But your point about a potential price level shock in a number of inputs at the same time that tariffs are potentially going up is, it's an issue, right? There's going to be progress on core inflation in the first half of the year because the lag impaired housing measures are finally starting to reflect current rents. But, you could have something of a goods prices offset to that. Goods prices are 25% of CPI. We'll get the new weights when we get the next report. But, and housing and CPI is 40%. So it's not a complete offset, but, goods prices won't mitigate that disinflationary pressure from house price, rent of shelter, OER, all that stuff. But, it's going to be an issue for sure.
Yeah. And I'm glad you mentioned the inflation debate discussion because that's kind of the last somewhat topic I wanted to talk to you, Barry, because, you have mentioned you're actually not as concerned about rising inflation in 2025 as maybe the market has made itself out to be, especially watching the move in the bond market. You've mentioned the labor market definitely not being necessarily a source of inflation, but with what I'm seeing on the physical markets, the commodity and the energy side of things, that could be the counter argument to where you're at. So maybe this all balances out, but I think we should maybe let the listeners kind of just hear from you. Where your thoughts are in inflation, why it doesn't necessarily concern you as much as maybe other participants in the market, and then what you're seeing that really. What would be, in your mind, the counter argument to your basic premise?
First of all, my view on why we had the inflation price level shock is twofold. It's what I described earlier with respect to how the Fed eased, causing a 46% 18-month increase in house prices. So the Fed owns the housing-related inflation. They massively increased the monetary base, more dollars in circulation. That's classic monetarism. That's inflation. And as long as you keep that rate suppression in place, you're going to have an inflationary problem from a longer-term perspective. And then the second was, is government spending at 25% of GDP. So that's an aggregate increase in, money creation, spending, deficit fueled financing that there's really no path to returning that back to where it was. And so again, that's an inflationary shock, right? So that's sort of core or super core services prices, government spending flowing through to service level inflation and a little bit on the goods demand side, but that's being offset by, Chinese deflation, which is why goods prices have been soft. But those are the two issues to solve to get inflation from, and I don't think there's upside risk this year, but nor do I think we're going back to 2% anytime soon. My contention has been, okay, headline CPI is running at 2.9%. The post-1947 average, when we started really calculating CPI on a monthly basis, is 3%. The standard deviation, median standard deviation, since that entire time period is 58 basis points. Now we're running at 36 basis points, so prices are stable. The trend is higher, but not higher than it's been over the long run. So it's not, if the Fed pushes too hard to try and get it back to 2 without shrinking their balance sheet and government spending going back to 20% of GDP, all they will do is crush small businesses, small banks, and really not achieve their goal, right? You need a whole of government approach. This is something Rob Kaplan, the former Dallas Fed president, always talks about when he's on CNBC, is we need a whole of government approach to really get inflation to 2%, if that's an even reasonable target. I think it is. But so, when you think about the inflation outlook, technically for this year, we finally got those, housing measures coming down because they're reflecting current rents. I don't think they'll stay down because Fed policy crushed the supply of housing. So what we're getting now is the effect of building that took place in 21 and 22 coming online and apartment buildings and the like. But that'll only last for a year or so, and then it'll start heading back higher. And in order to get really the fiscal inflation wrung out of the system, we need spending to come back to 20% of GDP. So I'm optimistic for this year, but not so much for the longer run, that we'll return to the disinflation that we had over the last 2 decades. And understand that disinflation only occurred because of the deflationary impulse coming out of China, right? Goods prices were 0 for 20 years. Domestically determined services and housing-related inflation was closer to 3. So the Fed kept trying to push inflation up. They did, right? They did on the stuff that they had some level of control over. And so that's, again, that policy was misguided for the last 20 years as well. All it did was cause capital misallocation, money to flow into private equity and private credit instead of actual capital investment, productivity enhancing type of investment. So that's kind of where I'm at right now. I don't think the Fed should be worried about it. The final point you hinted at or you mentioned was my view that the labor market's not a source of inflation. If you look at what the biggest surge in immigration, at least according to the New York Times, we've ever had, right? The percent of first generation immigrants in this country exceeded the 1890 high in 2023 or 24. That put a lot of pressure on wages for the lowest quartile of workers. The Atlanta Fed breaks all this out. And you could see that the lowest quartile wages were growing 3.6% faster than the highest quartile at the beginning of 22, before the immigration surge really accelerated. And now they're running at 0.4% below. So sure, you had disinflation, wage disinflation, but it all focused on that lowest income quartile. And now those wages are running much below the higher quartiles. And so slowing immigration may stabilize that, but it's not like we're going back to 3% tomorrow. So I just don't see this as being a real source of inflationary risk like the Fed does.
That Atlanta Fed wage.
Atlanta Fed wage tracker data.
That chart was eye-opening.
Yeah,
it blew me away. I had no idea.
No, it's really interesting. And the Fed tends to look at this stuff in terms of big aggregates and say, okay, well, wage growth is slowed. Yeah, but why did the election happen? Right? I mean, why did all these people vote for Trump? That's
exactly.
Right?
And it's funny because it's funny you say that. I'm in Vancouver the other night, and I'm going to bed, and I turn on the TV just to call it a day, and I'm watching the Frontline piece about Trump's second win, given this is Frontline and PBS, and it was all about him and actually what he did and everything in the kitchen sink thrown at him and how he overcame all these whatever it was challenges or mishaps, and some of it he caused on his own, some of it was complete BS. But what it basically was about what happened. What they neglected to do was even pose the question why it happened. The second one. And there's not enough people asking why this happened, because be honest with you, the people that should be asking the why are the ones to blame.
This is not dissimilar from what happened at the turn of the 19th century. We had that surge I just referenced in immigration, and eventually immigration got shut down in this country, right?
Yeah.
We had a similar percent of the population that was first-generation immigrants, and there was just a reaction to that. You read the history of trade policy in a book I can't recommend strongly enough, which is Clashing Over Commerce by Doug Irwin, a Dartmouth professor. Read his papers if you don't want to read this monstrous book, but it goes through the history of trade policy, and you realize what we, the United States, did in the aftermath of World War II is unprecedented. We unilaterally disarmed and lowered tariffs. And as I mentioned earlier, that reciprocity line, every nation is below it, charging us higher tariffs than we're charging them. And it's just, so history made Trump. Trump didn't make history. If it wasn't Donald Trump, it would have been someone else who would have come in, and it was just untenable, right? I mean, the benefits of reducing import trade barriers is diffuse, right? Everybody got cheaper stuff at Walmart, but the costs are acute. 5 million manufacturing jobs in the upper Midwest, roughly, those people suffered mightily. Everybody else benefited marginally.
Mm-hmm.
There you go, right? I mean, that's politics, so, and again, like, you let all these people into the country, and the pain of that was acute, right? Joe Sixpack, whose wages surged relative to, Mr. Wear a tie or wear a vest and go to work on Wall Street, had a brief period of their wages growing much faster, historically faster than Mr., the markets bro or whatever,
You think you just described yourself, Barry?
Yeah, I did, but I was trying to think a finance pro, right? Like that
Finance
commercial.
pro.
Is Bobby a finance pro? I love those commercials. Take shots, a bit, Anyway, the issue was that their wages didn't keep up with the price level shock. So even though their wages were surging, they didn't keep up with the price level shock. And then we tried to solve the problem. I don't know the real intentionality, but the Fed at least thought the problem was being solved because of the surge in immigration. It wasn't being solved, right? It was just the wage disinflation was falling on the backs of the people that got hurt the most by the price level shock. And then they had voted for Donald Trump. I mean, it's sort of obvious why the whole thing happened if you really dig into the numbers. And I thought you put it really well, which is, why did this happen? And it's not about Trump, really. I mean, he's an unbelievable, I've come to believe he's a political genius. I thought it was crazy strategy, back in 2015 and 2016, but, we've watched it work, right? And so he capitalized on all this, and, but it was inevitable. It was going to be something, right?
Yeah. Listening to his Davos speech this morning and some of the Q&As following the speech, I mean, I did have a chuckle because in the back of my mind, I was like, that's not right. But here we are. And that's going to happen over the next 4 years, including conversations like this. Excellent discussion here, Barry. I'm glad we can make it happen. I appreciate your time, and I know you're traveling and trying to enjoy life a little bit, but I'm very grateful for you giving us the hour, and safe travels back to Colorado, and hopefully you and I can get a ski in sometime before the season's over.
All right, awesome.
All right. Barry Knapp from Ironsides Macro, everybody. Go check out his Substack. It is a must-listen, deep dive. You always learn something. And that's a wrap here this week. We'll be back, regular scheduled programming next week. Have a wonderful weekend. Be well.